Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamowen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into a pressing issue affecting Ontario's housing market. According to recent data from the Missing Middle Initiative, Ontario has only managed to add 40% of the new homes it needed to keep up with its rapidly growing population. This shortfall is a significant contributor to the ongoing housing crisis in the province. The Missing Middle Initiative, or MMI, has revealed that from June 1st, 2023 to June 1st, 2024, Ontario's population grew by approximately 500,000 people. However, the province only added 82,000 new homes during this period. Based on MMI's ROCA benchmark, Ontario needed to start around 200,000 new homes to match the rate of population growth. This benchmark, although not perfect, provides a data-backed estimate of the expected number of households a community should have, considering age-adjusted headship rates from 2016. The MMI's findings indicate that the disconnect between population growth and housing supply is a primary cause of the housing crisis. This issue is not unique to Ontario, as almost no Canadian province managed to align housing starts with population growth in 2024, with the exception of Nova Scotia. Ontario, however, had the largest shortfall, starting less than half the homes needed. Despite the federal government's adjustments to immigration targets and non-permanent resident programs, which are expected to slow population growth in coming years, the need to elevate homebuilding efforts remains critical to address both current shortages and future demands. The Smart Prosperity Institute, linked to MMI's Mike Moffat, highlighted in a report last November that Ontario has been lagging behind other provinces in homebuilding per capita over the past 6 years. Ontario ranked in the bottom half among provinces, and recent data from the Canada Mortgage and Housing Corporation shows a decline in housing starts compared to last year. Looking ahead, Ontario has set a goal of building 1.5 million new homes by 2031. However, meeting this target will be challenging without significant changes in policy and development strategy. There are some positive developments, like Vaughan reducing its development charge rates and Toronto implementing measures to reduce building costs. Mississauga has also released a new housing task force report aimed at supporting housing development. While these initiatives offer hope, the province must continue to innovate and implement effective policies to bridge the gap between population growth and housing supply. As always, we'll keep you updated on any further developments in this crucial area. Let's turn our attention to the financial struggles many Canadians are facing today, as highlighted by a recent RBC poll. According to this survey, nearly half of Canadians say they can no longer maintain their standard of living due to rising costs. This is a significant finding, considering that inflation has returned to the Bank of Canada's target rate of 2%. Despite this, the financial strain on households persists. The RBC poll, conducted online with 1,515 Canadians between November 1st and 5th, 2024, found that 48% of respondents feel they cannot keep up with their previous standard of living. Additionally, the same percentage, 48%, believe they'll never be able to get ahead financially. These numbers paint a concerning picture of financial insecurity across the country. The poll also revealed that 50% of Canadians are spending all their income on essential bills and expenses. This leaves little room for savings or discretionary spending, which can have broader implications for the economy. Furthermore, 47% of respondents have had to dip into their emergency funds or retirement savings to manage these rising costs, showing the depth of the financial challenges they are facing. Another worrying statistic from the poll is that 60% of Canadians are concerned they do not have enough money to cover unexpected expenses. This lack of financial cushion can lead to increased stress and anxiety, further exacerbating the challenges households are experiencing. It's important to note that this survey does not have a margin of error, as online polls are not considered truly random samples. However, the results align with broader trends we've been observing in consumer confidence and financial resilience. The Bank of Canada is at the center of attention as it approaches its upcoming meeting, with many anticipating a potential cut in interest rates. The general expectation among market observers is that the central bank will reduce rates by a quarter point. This comes in the wake of a mixed economic landscape where domestic growth has been sluggish, inflation remains under control, and the Canadian dollar is not performing strongly. Despite these factors, a recent robust jobs report for December has sparked discussions about the possibility of an economic rebound. However, the looming threat of tariffs from the United States, specifically those proposed by former President Donald Trump, poses a significant risk to Canadian exports, which could complicate the decision-making process for the Bank of Canada. Dustin Reed, the chief fixed income strategist at Mackenzie Investments, suggests that the Bank of Canada is likely to proceed with a 25 basis point cut. He cites the underlying inflationary trends, weak demand, and a fragile labor market as key reasons. This sentiment is echoed by Citi economist Veronica Clark, who points out that recent softness in inflation data has increased the likelihood of a rate cut. The Bank of Canada has been on a rate-cutting spree, reducing rates in 5 consecutive meetings from June to December last year. This brought the overnight rate from a peak of 5% down to 3.25%, which is at the upper end of the neutral range, where rates neither restrict nor stimulate economic growth. Economists like Thomas Ryan from Capital Economics highlight the potential impact of the proposed 25% tariffs on Canadian goods, suggesting that the Bank of Canada may be swayed to cut rates further as a precautionary measure. In contrast, there is a small minority who believe the bank might hold off on a cut, with markets pricing in a 17% chance that rates will remain unchanged. The Bank of Canada's recent communication has shifted from a dovish to a more data-dependent stance, making its future moves less predictable. While recent consumer price index data showed a deceleration in headline inflation, this was largely due to a temporary sales tax holiday. Core inflation measures also softened, which could support further rate cuts. Some experts, such as Tiago Figueiredo from Desjardins, anticipate a rate cut at the upcoming meeting, but suggest that the pace of easing might slow down, possibly leading to a pause in March. This outlook is influenced by concerns over diverging policies with the United States Federal Reserve and potential impacts on the Canadian dollar. Growth forecasts are likely to be revised downward, with persistent unemployment supporting the case for another rate cut. However, the Bank of Canada is expected to frame these concerns in terms of their implications for inflation. Dustin Reed emphasizes that steep trade tariffs could disrupt stable inflation, which might prompt a more cautious approach to policy easing. Francis Donald, chief economist at Royal Bank of Canada, notes that tariffs tend to have an inflationary effect by raising costs, but they can also weaken the economy, introducing a deflationary pressure. This dual impact complicates the central bank's response, especially in sectors like housing that could be affected by interest rate changes. Looking ahead, Veronica Clark forecasts 3 consecutive rate cuts after the January meeting, potentially bringing the policy rate down to 2.25% by the end of the year. However, the scenario could change drastically if a full-scale trade war ensues with the imposition of 25% tariffs, which could alter both inflation and growth dynamics significantly. Toronto's real estate market has been under pressure, with many property types experiencing decreased demand. However, one type of property is defying this trend and continuing to attract buyers: townhomes. As of December 2024, townhomes have become the most sought-after property in the Greater Toronto Area, according to multiple reports, including one from the industry data firm Zonda Urban. This surge in townhome sales marks a significant departure from the stagnation seen in other segments, such as condominiums. Zonda Urban's recent report highlights that the latter part of 2024 was the best quarter for Greater Toronto and Hamilton area townhouses in 2 years. This is largely due to a relative affordability advantage that townhomes hold over other property types, making them particularly appealing to buyers. Royal LePage's latest home price update and market forecast supports this trend, noting a revival in the townhome market. One Toronto area broker attributes this to the affordability of townhomes, which is leading the market in activity. Meanwhile, condominium sales have continued to face challenges, with fewer transactions compared to townhomes. RE/MAX. Executives have also weighed in, predicting that first-time homebuyers will be a key demographic driving sales this year. Many of these buyers are specifically looking for townhomes and smaller residential properties such as bungalows, which are seen as more accessible entry points into the housing market compared to higher-priced detached homes. While townhomes did not surpass other property types in the total number of sales for December 2024, they did see the most significant increase in buyer interest compared to December 2023. The Toronto Regional Real Estate Board's Market Watch data shows that townhome sales rose by 5.8% across the 416 and 905 area codes. In contrast, condo sales in the region only increased by 1.7%, with the 905 area seeing a surge while Toronto proper experienced a decline. Detached and semi-detached home sales have seen declines, with year-over-year decreases of 5.8% and 9.8% respectively. This shift underscores the growing preference for townhomes among buyers, who are increasingly seeking out these properties for their balance of affordability and space. Overall, the data suggests that townhomes are becoming a preferred choice for many homebuyers in the Toronto area. This trend could continue as affordability remains a key concern for buyers navigating the challenging real estate market. We'll keep an eye on how this preference for townhomes evolves and impacts the broader housing landscape in Toronto. The Financial Services Regulatory Authority of Ontario, or FSRA, is taking proactive steps to enhance clarity and accountability within the mortgage brokering sector. They're currently seeking feedback on proposed guidance that outlines conditions under which team names can be used by mortgage agents and brokers in advertising. This initiative is part of FSRA's ongoing commitment to ensure transparency in the industry and to protect consumers from potential confusion regarding brokerage identity. Under the proposed guidance, FSRA emphasizes that all advertising by a team must clearly display the name and license number of the authorizing brokerage. This measure aims to reduce the risk of consumer confusion, ensuring that individuals seeking mortgage services are fully aware of who they are dealing with. The objective is to ensure that advertising practices are not misleading and that consumers can trust the information presented to them. Houston Loke, Executive Vice President of Market Conduct at FSRA, has stated that the guidance seeks to ensure that consumers are not misled by deceptive or confusing information. He points out that many mortgage agents and brokers use team names within a brokerage to advertise their services. FSRA expects these practices to be consistent, clear, and transparent, and they are eager to receive feedback to confirm whether the proposed guidance will achieve these goals. The consultation period is now open and will close on February 22, 2025. FSRA is encouraging stakeholders, including consumers and industry members, to provide their input on the proposed guidance. They believe that public input is crucial in making sure the guidance meets the needs of all parties involved and maintains fairness in advertising practices. To facilitate a comprehensive understanding of the proposed guidance, FSRA is inviting the public to participate in a live online session. This session will include an overview of the publication and an interactive question and answer segment. Stakeholders can review the proposed guidance and submit their feedback by visiting FSRA's website. FSRA continues to work on behalf of all stakeholders to ensure financial safety, fairness, and choice in the mortgage brokering sector. By seeking feedback on advertising practices, they aim to uphold the integrity of the marketplace and protect consumer interests. It's clear that FSRA is taking significant steps to ensure that the mortgage brokering sector remains transparent and accountable. We'll keep you updated on any developments and outcomes from this consultation process.